A very warm welcome to you all. Tēnā koutou katoa. My name's Cath Lomax and I'm the Chief Client Officer here at Fisher Funds. So a warm welcome to this webinar today, and I'm joined by Ashley Gardyne and David McLeish. So we hope you're all keeping safe and well during this lockdown. I know it can be really uncertain times for many people, and it can be quite impactful in many people's lives. However, at Fisher Funds, things have been running relatively business as usual. I say relatively because we're also dealing with households. And I was saying to Ash and Dave earlier, I did bribe my kids and husband and dog to be out of the house during this webinar time. So I'm not sure how well that's going to go. Fingers crossed it does. But it's great to have you joining us here this afternoon. So we've had an outstanding year here at Fisher Funds, and we've been really, had great markets, and we've been really proud of how we've been able to help our clients for their futures. And I guess some of the things that I love the most about Fisher Funds is they help people from really early on when they're first starting out with their KiwiSaver right through into their retirement years. And today's really about knowledge, as per the quote from the beginning, and having a chat to the investment team and asking some questions and letting them share their knowledge about what's happening and what do they do in their investments to make the very best returns for you as our clients. So before I start going over to the Q&A, just a couple of things I wanted to let you know. So firstly, the webinar is being recorded and it will be available to be shared afterwards. So please just let us know if you'd like a copy of that. Secondly, it's information only, so it doesn't take into account your own financial situation. But of course, as you know, we've got a great team of advisors that would be happy to help you. So please feel free to pick up the phone and email after this, and they'll be able to answer any of your queries. And then lastly, your participation cannot be seen by any of the other participants. So it's just the panelists here that you can hear and see. So we do really encourage your questions. This is what today is about. We decided to keep it short and snappy and find some questions. So I've got some that have come through from our clients already to start with, but you'll see down the very bottom of the screen, the Q&A. So just type your question in there and we'll do our very best to get back to you and answer it either on the webinar or afterwards as need be. So that's my intro, and I'm going to start with you, Ash. And I know we weren't going to talk too much about lockdowns on the call, even though I think it's day 7 already. But perhaps just as a start, how have the markets been performing, and how is the investment team going in lockdown, and sort of how does it compare to last time?
Well, thanks a lot for that, Cath, and it's certainly a great place to start because it is very different this time around than it was last time, particularly when you think about financial markets, and it doesn't necessarily feel that different at home in terms of being locked down at home and the amount of Netflix that's probably being watched around the country, but from a financial market perspective, it certainly couldn't be any different. So welcome along, everyone, and thanks for taking the time to join us. From the investment team's perspective, we're certainly fully operational from home, as Cath mentioned. The team are very busy working away on new investment ideas and looking for opportunities for clients. So that's great. And then, from a market perspective, as I mentioned earlier, things really are different. When we held these client webinars during level 4 last year, markets were obviously extremely volatile. Share prices were plummeting. There was a lot of uncertainty caused by COVID. In the last few days, and actually just looking at my screen overnight, we've actually seen US markets, both the NASDAQ and the S&P 500, hit record highs. So there is a big contrast there, and it actually does provide an example of the huge opportunity that there was in markets last year. And why are markets hitting highs? It's because we've seen that despite COVID over the last year or so, global economy and the domestic economy have done pretty well despite a pretty difficult backdrop. So it means while there's still a lot of anxiety around COVID, there's a lot less investor anxiety, and people are certainly looking through it. And there's belief there that the sun will come up tomorrow and things will get back to normal. And just reading through some of the press over the last few days, I've noticed that in the US, for example, the summer vacation season is well underway and national parks are fully booked out.
Yeah, thanks, Ash. And so if global markets are hitting all-time highs, what about the New Zealand market? What's happening there?
Yeah, and it's a very similar story, and it's in terms of the market backdrop being sort of pretty muted and not having much reaction. But it is surprising given we're dealing with a level 4 lockdown here, and most of the world is reopening. So there is quite a big contrast. And initially, when level 4 was first announced, we did see a bit of a drop in the New Zealand dollar. It dropped about 2 cents over the course of a couple of days. And I guess initially there was a reaction there by traders thinking that lockdown would hit the domestic economy, interest rates might come down a bit, and that would pull the New Zealand dollar down with it. But it really hasn't played out like that. And interest rates in New Zealand have been stubbornly high over the last week, despite what's been going on. And perhaps Dave will talk about that shortly. But then also from the New Zealand share market perspective, if you look at the NZX50, it's up about 3% since lockdown, which is quite amazing. But when you look at what's been driving that, there has been the strength of underlying corporate earnings in New Zealand. So we're right in the middle of corporate earnings season at the moment, and we've seen companies like Somerset, the retirement village operator, report some really phenomenal results, and even Freightways delivered some great results. And I guess while a business like Freightways is going to be severely impacted while we're at level 4, when we move back to level 3 at some point, we do know that freight volumes pick up significantly. People like to shop online, and that really drives e-commerce. And ultimately, people are starting to look through the short-term impact of COVID and thinking a bit further out. And we think that's a really great development. Ultimately, people have learned some lessons through this, that when you're thinking about markets, you need to think longer term than the current crisis. So I think that is one thing to think about. Ultimately, the returns you get in markets are driven by the success of the businesses you invest in, and the growth that those companies deliver.
Yeah, absolutely. Thanks, Ash. So, I mean, Ash, you mentioned around interest rates in New Zealand haven't moved that much, but also a great time to link Dave, you into the conversation here. And one implication of lockdown was the RBNZ not hiking rates last week. Can you talk us through why the RBNZ was going to hike and when this may come back on the agenda?
Yeah, thanks, Kath. I'd just like to say, first of all, how great it is to connect with everyone today. It's being back in lockdown really has been a bit of a harsh reminder about how important social interactions are for our well-being. So, although a virtual get-together is nothing like the real thing, it's really great to connect with people and bring us closer together. So, just wanted to get that out there. But yeah, Kath, you're right. The Reserve Bank does seem very keen to move the official cash rate higher. They clearly view this current 0.25% interest rate as an emergency rate. And they don't believe that that's justified any longer given how strong the economy's been recently. And Ash obviously touched on some of that just in his earlier remarks. In the monetary policy statement earlier this month, the bank actually said that they thought employment was actually already at or above the long-term sustainable level. So that's back to full employment, basically. And that has been the reason why there's been such strong household demand, and that's been the thing that's driven overall economic growth. Now, that doesn't sound too surprising to anyone, right? I think we can all see that. But what's really interesting is that both the Assistant Governor, Hawkesby, and the senior economist, Yun Ha, have actually been compelled in the last only couple of days to come out and push that very same message, despite COVID cases clearly increasing. So they really do seem very eager to raise rates. So yeah, the bank meets again on October 6th. So that meeting is very live, I would say. Of course, the uncertainty surrounding the length of the lockdown will be a consideration. But I've had some recent conversations with the Reserve Bank, and they've actually played down the impact that the lockdown will have on the economy. And that's, I suspect, given because of past experiences. So that has indicated that that they are looking to move, and they are looking to move quite quickly. Now, to finish, I suppose I'd agree that keeping interest rates too low is a dangerous ploy, and that's just because it obviously creates the wrong sort of incentives, like taking on too much debt or saving too little, or just generally taking too much risk. But I also don't really see that immediate rush that the Reserve Bank sees in raising rates, especially while clearly the economy's in what is the most restrictive lockdown on the planet.
Yeah, so I guess, Dave, questions come up here around rates, and it says, well, they have been low for a while. Where do you think they could get back to, and what does that mean for us, so as investors?
Yeah. Well, I actually wrote an article recently titled "The Folly of the Forecast," and that just simply suggested that people are pretty terrible at making predictions, even those that are supposed to know a little bit about the topic. So that article was really clearly aimed at investors blindly taking what the Reserve Bank tells them, and listening to those forecasts that they make for many years into the future. So I'm not going to fall into that same trap this time and kind of profess to knowing what lies ahead. But what certainly is very clear is that the New Zealand economy is very sensitive, and probably more sensitive to any change in interest rates than it has ever been. And that's mostly a result of the continued rise in household debt. That's a pretty obvious observation for all of us. This is important really because, last time the Reserve Bank actually set out on raising interest rates, that was back in 2014. They managed to raise the official cash rate by just 1%. Over the course of about a year. And that's before they had to stop, because those higher interest rates started to have serious impacts on, putting the brakes on the economy. Since then, household debt has risen over 60%, 60%. So to answer your question, I'd be very surprised if the Reserve Bank could fulfill their own expectations, which is that they take the official cash rate up to 2.1% by 2024. So that means that I think interest rates are going to remain low for a long time to come, although they're obviously most certainly not going to stay as low as they currently are today.
Yeah, thanks. So that gives us a bit of a feel for New Zealand economy and what's happening there with rates. Ash, back to you around the global economy. So I know you talked earlier a bit around, what was happening, but what's the outlook for the economy and the market globally?
Yeah, so as many people would have read, I guess, the global economy has been building up a real head of steam, particularly the US economy, and it's a good one to talk about because there's lots of data. But it's also quite relevant for us to think about in New Zealand, because we've seen the success of the vaccine rollouts in places like the UK and the US, and ultimately we're looking to achieve something like that. So what does it mean once we're through all of that? And what we've seen in many of these markets, a good example of the US is, despite unemployment hitting 15% at one point during the pandemic, it's now back to about 5.4%. As COVID restrictions have been removed, people have got out there and started spending again, and people are actually really flush with cash, whether it's because they haven't been traveling and spending on things like that, or whether it's been because of the government benefit programs, which have been pretty extensive in the US. There are literally record cash balances in banks at the moment, and people are out there spending it. And when you look at some of the more micro data, you look at things like domestic travel volumes in the US, they're actually back, ignoring the international portion, but the domestic portion in the US is back to where it was in 2019. Hotel occupancy rates almost back to where they were in 2019, and things like restaurant bookings have actually been above 2019 levels. So people really wanted to get out of the house and do some spending.
Yeah, and I can understand that.
yeah, and that's certainly held up despite the Delta variant. There's been a little bit of a slowdown in some of the restaurant bookings, but not really much, and it just shows the success of the vaccine programs, and people are feeling a lot more confident. And then from a share market perspective, what does that mean? Well, we've seen all that spending flow through to the corporate sector, and in the most recent US reporting season, which has just passed, 85% of US corporates beat what people were expecting in terms of earnings for those businesses. So corporates are doing really well. That's flowed through to the US share market and back to those all-time highs that I mentioned recently. You asked a bit about the outlook, and I'll take Dave's advice and not give too much of one. But what I will say is everything we've painted there is obviously very supportive for markets. So in the absence of some shock, it is really quite a supportive environment for markets.
Yeah, so it's quite quite a buoyant economic picture that you're painting. Quite a few questions that a lot of my team and the advisors are getting recently, Dave, is around this. Are we expected to see a surge in inflation, and what will that mean for our clients and investors?
Yeah, sure, Kath. That is a very hot topic at the moment. I think it's actually fair to say that we're currently seeing that surge in inflation. If you simply just look at the New Zealand Consumer Price Index, the CPI, that's risen 3.3% over the past year. That's the fastest pace in the last 10 years. So we're certainly already seeing that surge, I think. What's important from a saver's perspective is that while this cost of things has risen by 3.3% on average, well, actually term deposit rates have only averaged about 1% over that period of time. So that means that savers have actually lost that 2.3% of purchasing power on every dollar that they have sitting on term deposit over this last year. Now, that's a really big deal. So I can understand why it's obviously such a hot topic. So, to protect your money from inflation, you clearly need to have it invested into assets that can generate a return that exceeds inflation, right? To keep that purchasing power. So that doesn't necessarily mean that you have to take on a lot more risk, though. That can be certainly a bit of a misconception, I think. For example, our conservative fund generated a little over 5% return over the last year. So, even conservative asset portfolios can do better than inflation rates, even when they're surging like they are currently. Now, it's obviously important to recognize that, that past return is not a reflection of what may happen in the future, but it does really just show what the options are that are available to investors, rather than people that are squirreling their money away in bank accounts. As for the inflation outlook, well, our research suggests that there are a number of what we would call transitory factors, mostly related to the supply chain disruptions that we see here at our own ports, but it's certainly very amplified around the world. They're now starting to work their way through this global economy, and we're also starting to see signs, as Ash kind of mentioned, a lot of that demand is kind of back to 2019 pre-pandemic types of levels. We're starting to see that level off a little bit now. So when you combine those two things with then what I was just talking about, probably some higher interest rates in the short term, and plus a little bit less fiscal stimulus. Governments are definitely starting to step back a little bit outside of lockdowns with stimulating the economy. So all of those things combined tell me that we're probably pretty close to peak inflation for the cycle.
Mm-hmm. Okay, that's great. Thanks, Dave. So we've got quite a few good questions coming through. So I'm just going to start firing them at both of you. So here we go. So for you, Ash, to start with, we assume the defensive strategy you have for the vagaries and unknowns of COVID here and overseas don't vary from your normal day-to-day investment strategies. So do you want to talk a little bit about that?
Yeah, no, and it's a really good question. And I guess what the question's getting at is, does our investment strategy vary over time, and did we have to change things during COVID? And I guess the simple answer to that is no, we haven't. It's actually, our approach to investing has been guided by the same philosophy and principles we've used for the last 23 years, which is investing in high quality and growing businesses, so companies that have got a sustainable competitive advantage. And we actually, one of the reasons we do this, and the question mentioned the word defensive in it, is it actually, these quality businesses do actually hold up better in a shock. So we actually saw our portfolios hold up quite a bit better than the market in March last year during the depths of the COVID sell-off. So it does provide those defensive qualities. But while I guess another important point on that is, while a strategy doesn't change, it doesn't mean that the opportunity set doesn't change, because that's constantly changing. So we have a certain way we like to invest, a certain thing we look for in companies, but then where we look for those opportunities can change quite drastically through time, and that's where active management comes into play. So in the depths of COVID, for example, we had a lot of quite defensive businesses in our portfolio, some like consumer staples businesses and healthcare businesses that didn't fall much at all. We were able to sell some of those businesses and invest in something like Hilton, is a great example of a company we added to the portfolio that was right in the eye of the storm, but we thought it was a great opportunity to buy it and try and benefit from the rebound. So all of those businesses are high quality businesses. It's just, you look at different parts of the opportunity set at different times, depending on what's priced. So I guess, yeah, our style hasn't changed. It's always been the same, but the opportunity set does move pretty significantly, and that's why you want to be active.
Yeah, absolutely. And another question for you, Ash, I'll find one for you soon, Dave, is, given the recent Alibaba Group volatility, what do you see as the longer term risks, e.g. government intervention, and what are the opportunities in the Asian markets?
It's a really good example, and for those on the line that don't follow it as closely, a lot of the Chinese tech stocks in particular have had a really hard time in the last couple of months, and I think Alibaba's down about 25%, or almost 25% for the year. And we often see like no stocks are without risk, and the Chinese stocks in particular do have a lot of government risk there. So we manage that to a reasonably small portion of our overall portfolios, but we still do think there are some great businesses out there. But what we're seeing in China is effectively regulators and the government there are trying to catch up with other regulators globally that have more stringent data protection laws, antitrust laws, consumer protection laws, regulation of fintech platforms and that sort of thing. So China's really come out with a suite of new regulations, which appears like a bit of a crackdown on the tech sector. And the reality is some of those things will create a bit of a headwind for Alibaba, but ultimately we think it's legislation that was needed to improve those sectors. But whenever the Chinese government does crack down, we see significant sell-offs in tech stocks. And I can remember back to 2018 when Tencent, which is the largest gaming player in China, fell about 40% because the government was cracking down on video games and how much time kids were spending playing video games. New legislation came out, Tencent came under a lot of pressure, but ultimately it was a great time to be buying Tencent. And we think it's the same with Alibaba. We think, yes, there are some new regulations which might introduce some new competition, but they're still the dominant player in the e-commerce sector. On top of that, they own the largest payments platform and also the largest cloud computing platform. So we actually see events like this often as a pretty good buying opportunity, but you do have to keep them at the right size in the portfolio because there are some tail risks there as well.
Yeah, absolutely. So I've got a question here, which is actually for me, so I'll answer that. That gives you guys a break. The question, some of us have sold off rental properties due to government policies, invested in PI funds, etc. I've invested with you. Have I done the right thing? So I guess the best idea is talk to your advisor. I think everybody's financial situation is different, but that's what your financial advisor is there to do, is to help you through what are the best decisions that you should make. So I just encourage anybody to pick up the phone and have a chat and talk through the options with your advisor. Dave, I'm going to go to you now for a question. And I guess earlier you painted a picture around a pickup in inflation being transitionary. What happens if it isn't? So how would portfolios perform in a higher inflation environment?
Yep. There's certainly a lot of debate about this one right now as well. So unfortunately, I don't have all the answers, but history is a pretty good guide for these sorts of things. And that suggests that actually equities or shares perform pretty well in most inflationary environments, especially the shares of companies that maintain their purchasing power. Those are the ones that can pass on those increase in costs that they are feeling onto their customers through higher prices to ensure that they maintain their margins. You'll actually hear Ash and my other equity colleagues talking about that quite a lot, because this is one of those key factors that they look for when they're selecting equity investments. But typically the assets that generate a fixed level of income, like fixed interest, for obvious reasons, are those that perform the worst in those sorts of inflationary environments. And that's because, again, going back to that purchasing power of the income that asset generates, gets eroded away by inflation, because you've got a fixed amount of income that's coming in, and if the cost of things are going up, then your money doesn't go as far. So none of what I've just said there is obviously particularly useful for those sorts of investors that feel a little bit less comfortable investing purely in growth assets like shares. And the answer for those kinds of risk adverse investors is really diversification. I mentioned our conservative fund earlier, and that has approximately 70% invested in income generating assets like bonds, so much more or less volatile assets. And the other 30% is invested in equities or shares. And in the past, that balance between smoothing out that investment ride in both inflationary and less inflationary environments has usually put investors in pretty good stead.
Yeah, great. Thanks, Dave. So Ash, I am going to go to you with a question around the biotech sector. So are we looking to add any biotech stocks to our growth funds?
Yeah, it's a really good question, and it's actually a sector we don't spend a huge amount of time looking at. I know the New Zealand team do follow those companies loosely, but I talked earlier about sort of what we look for in companies and companies with a sustainable competitive advantage, and ultimately what we're trying to do is find businesses that have already won in their sector. So if you think about search engines, we invest in Alphabet, which owns Google, because they sort of already dominate that market, and there are lots of examples in our portfolios like that where we think the company already has the lion's share of the market and they've got room to continue to grow. When it comes to biotech, you can absolutely, if you pick the right companies, you can make phenomenal returns. It just becomes very, very difficult to pick which company is going to have the next winning drug. And it's an area where even if you do have significant expertise, you might make a number of investments, get most of them wrong. You're really hoping to get one of them right in a big way, but that's just not the way that we really invest. We prefer to pick those companies that have effectively already won and then just try and buy them at a time when we think there's a really good opportunity for good returns.
Yeah, absolutely. And I've got a question here, which is a bit around that I'll answer actually, which is around client satisfaction. So just interested in what we do to, really look and make sure that we're giving our clients the very best experience, which is obviously a priority us. So we do quite a lot of client research, and in fact many of you may have got a survey recently asking how your advisor went, and so we're always looking at that and how we can make improvements, whether that's through our website or what we do. I know recently when we did the survey we got a lot of fantastic feedback from some of our clients. Now we have offices in Christchurch and Wellington, and a lot of our clients really enjoy when we can having a face-to-face or having someone local being able to help them. So, but we do really want to hear any feedback, and I, as the team knows, I always welcome any phone calls or emails for feedback from any of our clients at any time. So yeah, that was a good question to have on here. So I'm going to have a look at a question for you, which I think is quite topical, and I think we've got time for a couple more. And Ash, it's around clean energy companies, such as hydrogen as opposed to fossil fuels.
Yeah, so we absolutely do have a number of investments in clean energy, both in our New Zealand funds and our property and infrastructure fund. It tends to be more in generation companies that own wind farms and the like, hydro assets, as opposed to hydrogen, or we do get asked quite frequently about electric vehicle stocks as well. And again, it's back to that same dynamic I mentioned on the biotech. It's very hard. If you think about electric vehicles in particular, there are literally hundreds of players trying to get new startups up and running there, and there are lots of companies that have listed over the last year. It's going to be very difficult to pick who's going to be the winner in those areas, and a lot of those companies are already priced to perfection. And we often find the same when we look at things like hydrogen technology. So I sort of put them in a similar camp to biotech. If you're an absolute expert in those sectors, then maybe you can carve out a niche for yourself to make some good returns, but it's not really the way that we approach investing.
Yeah, no, absolutely. I think I'll do a couple more question each for you. Feel free to put any more on, those of you that are with us, and I'll do one more for you, Dave, and then one more for you, Ash. So for you, Dave, the global central banks are playing a bit of a risk game, keeping the rates extremely low and printing money. Will that keep going despite the strong economic rebound?
A topic very much close to my heart. Thanks, Dad. Really appreciate you giving me that layup of a question. The short answer is yes. But I would say that getting that right balance of being too stimulative or too restrictive really is pretty difficult for central banks. So we'll give them a little bit of a break. What is really important though, and I might rant a little bit here, is that I think the most important thing to recognize is that actually central banks have erred on the side of being too stimulative for about 30 years, and by keeping interest rates lower than what they otherwise would have been at that time, they've essentially aided and abetted this massive build-up in debt around the world. So, that's all great when this debt has been accumulated, because, what is debt? Well, it's effectively spending today to have to pay it back tomorrow. So that's spending and consumption and therefore growth today. but it's not so great when you're left having to pay off the bill. And that's where I think we're starting to find ourselves. So that therein lies the problem. The global economy needs low interest rates to keep enticing people to borrow and spend and therefore grow. But that is also, like I was saying earlier, the same reason why interest rates don't have to rise very far to have a pretty meaningful impact on slowing down the economy. So I guess it might feel like central banks have still got this punch bowl in front of the global economy at a time when the global economy is recovering and doing very well, and it kind of does. But what I would just say is that it might not, this punch bowl might not be as stimulative as people might imagine, because we're just in a different environment now whereby the economy is just so much more indebted.
Yeah. Okay. Thanks. Ash, I'm going to try and put two questions in one because we're getting quite a few through. So there we go. I think we can go for a couple more minutes. So will you increase your holdings in healthcare? So will you look to include ETFs like Vanguard, Russell in your mix in the future?
Yeah, so we do certainly invest in quite a few healthcare companies, and looking internationally, in the fund that I manage there, we have a number of great healthcare companies. We invest in a company called Edwards Life Sciences that makes heart valves. We really like that medical device sector, and healthcare is, we think, a really important sector for us to have exposure to. It's a growing sector. As the population ages, there's lots of innovation there. So as we develop new technologies like heart valves is a great example, we can all of a sudden solve problems that we couldn't solve before. So if you find the right businesses in those sectors, there are great growth opportunities. And we are looking at a number of, Chris and our international team is actually looking at 3 or 4 healthcare companies at the moment that we find quite interesting. So it's a good question, yes, and absolutely. We look at the healthcare sector and we really like it.
Great, okay. And another question for you, Ash, that I'm tagging on to make it like 2 more questions in one. Are you finding corporate management sticking to their strategic direction and skill sets without the volatility of a changing world?
No, it is a really good question. I actually think COVID provided a really good opportunity for companies to go almost back to basics and revisit their strategy. And there was this time last year when profit margins were getting hit and revenues were getting hit, and businesses just had this real impetus effectively to adopt digital technology, for example, so their workforces could work from home. And a lot of businesses took that as an opportunity to bring forward a lot of investment that they had put off for a long time. So a lot of retailers, for example, were sort of trying to figure out whether they should go down the e-commerce route, yes or no. It's going to cost a lot of money when we do it, but so there were a lot of people were holding off on making a lot of those investments. And actually, the pandemic caused a lot of retailers in the US in particular, like Walmart and Target, really to accelerate their e-commerce strategies. And the same thing can be said for corporates with cloud adoption and the government sector employing and using a lot more software. So we have seen this period result in a lot of businesses, I think, from a strategic perspective, really think about where they want to be in 5 years' time and actually bring forward a lot of that investment, which I think is great. Rather than managing quarterly earnings, they're actually doing what they should be doing and thinking, how can we make this a better business in 5 years' time?
Yeah, exactly. That's good. Dave, I'm going to sneak one more in for you. This is the last one, I promise. So there seems to be a trend and focus in ethical investing. Is this incorporated into your investments?
Yes, it is the short answer. And the reason that it is we assign a very high value when we're looking at companies and either lending or investing in them to the strength of the business, the long-term strength of the business that we see. So businesses that are not good corporate citizens or are not doing the right things from a climate perspective or a social or societal perspective really don't cut it for us and never have. So business strength is a key aspect that weeds out those types of companies from our investing process. We've obviously also got a very extensive exclusion list that precludes us from investing in a number of not only companies but industries that we believe that are just are not doing the right things from a corporate perspective. So yes, ethical investing is extremely important to us, and it really sits inside of the broader responsible investing umbrella that we take very seriously. I would just say that, you know, this is kind of an evolving space though, and one that we're trying to get better in as well. You know, understanding you know, the needs and desires of society and how we can play an important role is kind of this evolution that we're all on. So we're all learning and trying to get better in this space, but staying close to the companies that we invest in and pushing for change when we feel as though they're moving in either the wrong direction, have had some sort of indiscretion, or just simply need some extra help moving in that right direction. We're always, you know, very close with those management teams and enjoy those discussions and try to push for that.
Great, thank you. I think that's most of the questions we've answered now, or hopefully we have. If we haven't, then as I mentioned before, someone from the team will be in touch to answer those. And the great thing I love about Fisher Funds is that the investment team work very closely with their advisors, and so if any client's got a question that the advisor can't answer, we always talk with the investment team as part of that. So we've really enjoyed having you on this afternoon and sharing the great knowledge that Dave and Ash have. And so thank you. And I hope if you've got any feedback on this webinar in general, please feel free to drop any of us a line. So thank you and have a good afternoon. Thanks, Ash and Dave.